back there. How much do I have to talk a lot louder, Josh? Good? Okay. Awesome. Well, thanks everyone for joining. We just flew in from Philadelphia. Our flight was delayed, but we got here in time. So it's good to be here. It's good to be back in person doing these seminars. I probably gave dozens of virtual seminars over COVID, and now the default is in person. So it's really fantastic. And thanks for hosting, Robin and Fedor. Thanks for setting this up. And today we'll be talking about a bunch of things, but it's all around the early days of building your company from an equity perspective, and kind of how that equity goes down over time, given what is required to build a large company. It generally, unless you're an anomaly, it requires taking in capital from venture capital. And so, ideally, like as one of our old colleagues used to say, you can either have a big piece of a small pie or a small piece of a big pie. And in most venture capital startup worlds, you're going to end up with a small piece of a big pie if everything works out well, and that's going to be a big return for you. And so this will be a talk around all of those things. How you start your company, how you split up equity amongst the founding team, why dilution happens and how it happens, and then also the terms by which venture investors will dilute you with their capital. So we'll jump in there. So just quickly on me, I work at Osage University Partners. I've been there now for about 7 years. We're a venture capital fund that partners with universities to invest in spin-outs. So I think the audience looks very senior here. So like, how many of you are in grad school right now? And undergrad? Any undergrads in the room? Great. Any postdocs and faculty? All right, awesome. So it's just a very great audience for what we do at OUP, which is work with researchers to invest in their startups. And we do that via close partnerships with universities across the country. We've been doing this since 2008. We have $800 million that we invest out of, and we've invested in probably about 130 university spinouts over the years. Duke was one of our first 5 partners, so it's like a really close relationship for us. My background's in applied physics and aerospace engineering. I went to work for Lockheed Martin for a number of years before joining OUP. But most importantly, as proof, I was a Duke undergrad, and I'm somewhere in this crowd, maybe right there. So it's fun to give talks at Duke. I would be here all the time if I could. It's such a good growing university from a research perspective. And so, think of you being able to access me as much as you want, because I'm always happy to give back to Duke. So the first part of our talk is on founders' equity. And think of this as the way you should be using ideas around splitting up your equity amongst the founders of your company. And so for most of the spinouts that we work with, that I think most of you may consider in your future, this may be a couple researchers, some combination of 2 faculty members, 3 faculty members, 1 graduate student and 2 faculty, 2 faculty, or 2 graduate students and 1 faculty, 4 graduate students and 1 faculty member. It's really complicated, it's really messy, but it's really important to figure that out early on. And so the general terms I think you should be thinking about around equity are simple. You're rewarding for past performance. What have you done in the past to contribute to the future of the startup? And then incentivizing future performance. Those are just the 2 good rules of thumbs, buckets to measure your co-founders with. And so for a faculty member that's been researching for 30 years on a topic that they've had a huge patent portfolio built on, and that's going to go into the startup, that is a major contribution into past performance. Obviously, it's more of a contribution than the graduate student who's been there for 4 years pouring his heart and soul into it. How much it's worth is what we'll discuss, but that is past performance. Future performance is just as significant, and it's a different kind of grind with higher stakes. People going into a startup usually have many other options. If you're a faculty member, you could stay the course. You could go work for one of the big tech companies nowadays pretty easily. You could be making a lot more money doing other things. Similar to a graduate student coming out of graduate school or a postdoc, you could go work for a major corporation, a startup, a big tech company, make several $100,000s a year nowadays. And you're choosing to work for a startup and put that all at risk, and it's not because you're going to get a huge salary. And so you need equity to incentivize that future performance so that it's worth the grind. And it's going to be several years. There's no way of planning on a quick flip. Whenever we talk to a startup that says, oh, I think I can be acquired in 2 years, one, it doesn't happen. Two, it's not that interesting to venture capital investors. And I'll get more into that later. So the general rules of thumb for founders' equity split is our rule of thumb. It's not what you may hear from every investor in the world. You may not hear what you hear from every group in the world, but it's just something we've learned over 12 to 13 years of investing in university spinouts. And so think of this in terms of 3 buckets. There's a lead founder CEO person. And this could be a researcher. It's not always the case, but it's someone who ultimately will likely become the CEO or is out the gate that strong CEO. The best situations, which happens very rarely, are when a few researchers at a university end up getting together with an experienced entrepreneur who is clearly that CEO. And it's worth giving them a large portion of your company, even though they haven't necessarily been doing 5 to 20 years of research on the topic, because they can be a big difference maker. But it can sometimes be the researcher. And that researcher, the graduate student, the faculty member who would become the CEO, isn't just a leader because they kind of ran the group or they ran the research project. It's because they love all the other stuff that you'll be doing as a CEO. They like pitching. They're good at pitching. They like building teams and helping people work through their own personal problems that'll happen at work. You have to like all that stuff. And that person may deserve more equity than the other co-founders who will still be putting their heart and soul into the company. So think of that 40% bucket for the lead founder CEO as something that you have to carve out in your mind. And the other 40% bucket is what other founders will be fitting into. So sometimes you don't have the CEO figure at the start of your company, so you want to reserve it in the back of your mind as when you do find that CEO, they are going to receive a big portion of your company, depending where in the process that happens. There's no formulas here, though. Some terms I just wanted to work through for the audience because this is going to come up in the conversation. So that was the pie chart that we'll dive more into for equity. But that equity percentage, how much you own of the company, gets diluted over time based on how much venture capital you bring in. So I just wanted to do like a VC 101 on some of these terms. Pre-money valuation is what your company is sort of worth today at the time of investment. So this is like if a venture investor is going to give you money, you set terms. One term is the pre-money valuation. I think you are a $10 million company, and I want to invest $2 million in your company, and that's going to be a $12 million post-money valuation. So I'm buying 2 divided by 12 of your company, so 16%, let's say. The fully diluted amount is the total amount of shares or equity in your company. Preferred stock is what investors buy. Common stock is what founders have. There's a big difference between the two. We'll get into it later. But as an investor, I'm buying in on preferred terms. And as a researcher or founder or an employee, you're likely getting common or options. Feel free to interrupt me with questions at any point. All right, so this is like the only intense math you'll have to go through today. I'm sure you all have seen more complicated things. There's no rocket science here. I encourage everyone to buy the book Venture Deals by Brad Feld. It just really just goes through this in a simple way. But think of if you're starting your company, you've kind of figured out some of the equity setup that you think is appropriate for your team, and you're going to go raise. One question is, how much should you raise? What's the right capital raise amount? And the amount of capital you raise is amount of time, is some function of the amount of time and OpEx, operational expenses, sales, and back office stuff, R&D, and CapEx, what do you need for equipment to get to the next major milestone. So obviously you can project out what it's going to take to build your company over the next 5 or 10 years, and you could raise all of that. But if you raise all of that today, you'll receive more dilution than you would if you hit the first milestone and then raised after that. So generally, like, think of the time as some function of, like, you don't want to have to raise at a higher frequency than every 18 months. So raise in 18-month increments for the most part, and the OpEx and CapEx associated with getting that point. So try and make sure your company has milestones that can be achieved in kind of like this 18 to 24-month window, so that the valuation at your next round is much higher. And so we'll go into this a little bit. Valuation there's not a great science to this, especially at the early days of starting your company. It's some function of revenue, which none of you will have at the start of your company. The product, which is the vision of your product. How compelling is it? How big is the market you're going to go after? And ultimately, like, what's the experience of your CEO for the most part, but your team? And some multiplication of, like, risk, which is a venture investor's very non-quantitative way of kind of pattern matching of the risks associated with what your company's doing and where you're at. And that capital raise and the valuation sets the dilution. So I described before a 2 on 10 pre-money, 2 on 12 post-money. 2 divided by 12 is, 16%? That's the dilution you will receive. So if you owned 100% of your company and you take an investment at 2 on 12 post-money, your dilution goes down. You're going to own 84% of your company after that. And just that, gets multiplied down every time you raise a new round. And so the goal of raising $2 million is so that the next time you raise, let's say you're going to raise $10 million, your valuation isn't 12, it's 30, 40, so that your dilution is less over time. And some of that is, what we'll go through later in, like, looking through how ownership at the start dilutes over time through a series of successive rounds. I just wanted to kind of share some data that we collected years ago, which is the average university spin-out raises $41 million across 4 rounds of financing. Most of them fail, but the ones that have been successful exit for around $240 million. And so this is kind of just a way we constructed this dilution table you see here, which I will go into later. But think of it as, if you start with 20% and you kind of raise multiple rounds, 4 rounds, over time your dilution will be such that you'll only own 12% of your company as a group, right? So if you started with 20% as a group, I think that's what this is saying, yeah, 20% as a group, then you'll compress down to 12% as a group. So it's significant, and what you'll find is that the most optimal thing you can do as a company to increase how much you own at the end is by using the capital you raise to increase your valuation after each round. Yep.
Is that across all industries? Is it tech, biotech?
No, I mean, especially over the past 2 years, it's kind of been wild.
Yeah.
Where companies may raise $500 million and exit for $5 billion, and some may exit for 0. So it really depends. And it's more just set up for this talk as a way to work through later an example of how that fundraising affects your ownership. Most university startups recently, if we were to update this data, it just seems like the ones that are on the trajectory up are raising anywhere between $30 to $200 million.
Yeah, in the first round.
In life science, absolutely. Yeah. So getting back to founders' equity, we would always receive, like, lots of questions from researchers, the startups we speak with, and the tech transfer offices we work with about, like, well, I'm like, there's a professor and a graduate student, they're trying to figure out what the right equity balance is. Like, what's the right equity balance? And we don't know, but we know what we invest in, and that's biased. Like, these are the startups that we invest in. And we went back and surveyed our 100 or so portfolio companies and their cap tables. Cap tables are just basically a ledger of who owns what. Say, okay, what did these companies look like at their founding? So this is an example of the data behind 100 or so company cap tables of the companies we invest in. As you get to know our fund, we invest with other really great venture funds. So this is a sample of the cap tables you'd see of a very high quality group of startups from very high quality investors. So think of it as, if it doesn't fit this mold, it's just going to be a little bit harder to get a group of high quality investors into your mix. So we went through and labeled all the different names on a cap table, whether there was a founding CEO, a founding inventor, how many there were, whether there was a part-time faculty member or a full-time faculty member. You see this, like sometimes you have a faculty member that says, I'm going in. I'm going to leave the university for 2 or 3 years, work full-time. There's some that just, it's not in their interest, or they can't do it. And so they stay working 1 day a week, maybe no days a week. And so there's lots of different approaches to being a researcher at a university and being a part of a spin-out. And then also, since we work with universities, the universities are on some of our cap tables, almost all of them, for the equity piece of through the licenses that they set up with the startups. That represents all the work the university put into setting up an environment where you could get research dollars, get your startup package as a professor and a group that helps them offset the cost of your patents, but then also the arbitrage of like, well, they may have been able to license it somewhere else, but because startups are such a big part of the institutions nowadays, they want to see more spin-outs. And so we went through and looked at all this data. You can see there's big error bars here, and so it's not a science, but it's just meant to give you kind of a placeholder. I'll go through more of that data in a little bit. In terms of takeaways, a couple interesting tidbits. So, founders committed to full-time roles just get more ownership, as I described. So if you're not going full-time, you shouldn't expect to have more ownership, even though your past contributions may have been significant. 10 of the 63 founding CEOs in our data were previously a professor or a graduate student. And the PIs turned CEOs receive something like 41% of the equity, which is significant. Like when they do decide to go full-time, they do end up getting a big chunk because their past contributions were significant and their future contributions are significant. But that really only happens in tech spin-outs. It doesn't necessarily happen in therapeutic startups, which Duke is very prolific at creating. There's also been some great tech spin-outs at Duke, but across the board, most of the time, if you're in the life sciences, I'll probably be specific to therapeutics, not devices and diagnostics. But in the therapeutic space, usually professors aren't the CEOs. Yeah.
What is PI?
A principal investigator. Usually it's a professor, I think of it as. So then we went through that scatter plot you saw and tried to create some bounds. Showed you the pie chart earlier. This is meant to be more prescriptive. And think of this as the percentage. So from this, don't worry about this section right now, just focus on the top section. This is at founding, before you've taken a single dollar, and before you've created this option pool. In the pie chart, I don't think I mentioned, there's a 20% slug of options. This is what you hire your other new employees with, since you can't pay them much salary. So you give them ownership in your company. But before you're taking your first dollar, before you create the option pool, generally thinking, like the founding CEO, probably a 30% piece of your company. If you have a group of founding inventors, professors, postdocs, something like, if you have 2 founders, 20% plus or minus 10. If you're a part-time faculty member, for those in the room who are faculty, like it's actually not as big as many people think. It's a 5% piece is what our data has shown. And I've had many conversations with faculty separately, with graduate students separately, trying to figure this out, with both of them together on the same call, trying to just collaboratively figure it out. You have to have this discussion when you're starting a company with your PI, with your professor. And it's awkward, because if you're a graduate student or a postdoc, they're your advisor. They hold the keys to the kingdom of you leaving. But it's not going to be a good relationship going forward for the startup if you can't have that discussion at the earliest days. And then as you bring in other executives, like chief scientific officer if you're a life science company, or a VP of engineering if you're a tech company, they may be 10% type owners, even though they're coming in not from the technical perspective or not from the research perspective. And on the university side, there's obviously also a big range. They may look for 3 to 12% equity in your company, depending on the dynamics of what created that option pool, of the patent pool and the resources attached to the effort and the sector you're in. So, any questions on this so far? Okay. And then, since many of you may start a company without that CEO in place in the early days, you're probably going to raise your first round. It'll be a seed round. It'll be a modest amount of capital. investors will sit on your cap table, you'll have an option pool, and then hopefully, you may encounter a great CEO who you want to bring into your company. And that person really does deserve a significant portion of your company. So if you hire them at the Series A stage, you're looking at something like giving 5 to, I've seen 15% or so for those great CEOs, and they're worth it. If you can get that person in, give them the equity that incentivizes them to stay at your company. If a CEO comes to you and says, oh, I don't really care too much about equity, pay me $500,000 a year, which is what I was making at Google, just run away. Like you want that person to be baked into the success of the company and realize his or her benefit is only going to come if the company's successful.
What about like management consultants or someone does your legal, like compiling of that?
Yeah, there's a big range. So some law firms are taking equity in exchange for payment, and it's really hard to say. Like usually, what I would do with any of those types of efforts is not give them a percent of the company, but give them a note equivalent, a convertible note, equivalent to what their expenses would have been. So if they're investing $100,000, like if let's say you spend $100,000 in legal fees, and they say, oh well, we think this is worth 10% of the company, whatever. Like it basically means they think your company is only worth $1 million, and who are they to say what it's worth? They don't have that experience. That's why as you take your first angel dollars round, if you're raising a small seed round, letting angels price your company is also risky. There's a whole other discussion on how you price your company, and in general you say let the market decide, but that market has to be sophisticated and know what they're doing, and so that's why convertible notes exist. We can go into that later, or we'll go into it later. But other things to think about are advisors, like real advisors, board members, a board chairman, an executive chairman, someone who brings a ton of industry knowledge. They might be something like 1% of your company early on. I think we're doing okay on time. So, yeah.
If you need to move on this guy,
Oh, no.
To what extent I know a lot of spin-outs from universities don't have revenue, but to the extent that one does, how does that affect the numbers? Is that kind of applied to the risk part of the equation?
I think so. From the perspective of founders' equity, or like about,
Does it matter? Just does it affect the value?
I don't know how it affects founders' equity.
It's more the valuation.
It's more the valuation that your investors should give you when you go raise your round. With specific, when and Duke has a number of these startups that build healthcare IT solutions within the hospitals, have a little bit of revenue, oftentimes from the home court, right, from Duke, and it's really hard to call that true revenue. So it has to be true revenue. I'd say I've rarely seen this. Like I've rarely seen startups have true revenue before they spin out of the university, unless they're in licensing technology, like they're already a fully running startup, and they're in licensing technology from the university, and they're not the inventors of the technology. So we can talk about it more offline. It seems very specific, is what I mean to imply. So let's say you're a faculty member, or you're a postdoc, you're going to stay at the university, you're going to found, because you're a part of the founding team, but you just don't want to move into the startup. There's still a ton of value you get out of that person. And in the tech industry, some professors may leave for a year or two, but they'll return to the university at some point. And you can still incentivize them to contribute to your startup with vesting or with options. And it's really helpful because, especially in life science too, thought leadership in the space, getting the attention of corporate partners, being a recruiting engine for the startup going forward. These are all things that your faculty co-founders can be really exceptional at, and you should leverage that. And it's what you should hold them to as being a part of your company and being on the cap table. Being on the cap table is significant because everyone we see on the cap table, we want to understand generally, if they're above, let's say, a couple percent, what they're doing. What are they doing to help the company? If they're not doing anything to help the company, you kind of just want to know why. And that's something that we pay attention to. So when you don't set up your cap table correctly, when you don't allocate equity in the right way, it can be painful. Think of venture investors. From your perspective, right? You have someone who maybe is a co-founder, You didn't talk to a lawyer when you were setting up the company. You didn't get input from Duke OTC about how to set up a company. You didn't put a vesting schedule on your founder's equity. You didn't set up any like terms of, hey, we're gonna found this, do this company together. What do we expect of each other? And so you have a graduate student who could have gone to Google and made $500,000 a year, but instead he went to the startup for 20% equity and 100K a year, and life happens, and he says, oh wait, I need to make real money, and so he leaves the startup with all of his 20% equity still intact. And now you're staring at him sitting at Google making a big salary while you work your ass off trying to build this company. And that's really frustrating. And that's a parasitic founder, and it shouldn't have happened, but it happens. And it's really hard to take equity back once you give it to someone. It's obviously legal paperwork, it's gonna cost money. Once someone else invests in your company, you're also gonna have to work with them because they're on the cap table. You can't just bring someone's shares to zero. And you also have a lack of equity to give other people you want to hire into the company. And that's a big deal because anytime you need to hire people, you need to give out these options that I talked about before. You may start at 20, but over time, you're going to give 10% to that new CEO, a percent to your VP, it's going to go to zero, and you have to refresh the option pool, which is totally fine, but that dilutes you and everyone else on your cap table. And if you have that person who's sitting at 20% doing nothing, you wish you could just grab those shares from them, but you can't. And so the only way to fix that is to recapitalize the company, which is really painful. It's basically bringing the company's value down to zero. You reassign shares how you wanted to, and no one wants to do it. Venture investors are always looking for a reason to say no, and this is just one of the many reasons we might say no to your deal. So just be smart when you're working with your co-founders, and that'll just help you build this company in the right way. Same applies for bad investors. If you take capital from someone who is not going to contribute to your company, or you're just not on the same terms with, it can just lead to problems, the same exact problems. And so if for some reason you accepted a term sheet from a group where they own 30, 40% of your company and they're not delivering that much value, it'll just be kind of frustrating for you when you take on new investment. And so when you're taking on these early stage investments from angel groups or high net worths or pre-seed funds and seed funds, and even my style of fund, just like make sure you're paying attention to all the terms. And the other section of this talk is going through some of these terms that can create problems. Things to figure out early, make sure there's no strange liquidation preferences. We'll get into that. Misaligned exit horizons. It's always surprising to me the angel investors that I sometimes see around university spinouts and even pre-seed companies that are looking for like real hard tech opportunities don't realize that these companies may take 8 to 12 years. And so just make sure that time horizon is well understood with your investors, because it's hard to just exit a company whenever you want to. Any questions on this general category? So the option pool is something I briefly talked about. It's when you use equity in your company to incentivize your team to join. It's your hiring tool, and you use it to build your team. You have to refresh it every so often when you have turnover. If someone leaves, if they vested, vesting is when you actually own your options. You have to refresh that. You can't just get it back from the person that left. And then every time you raise capital from venture investors, your option pool gets diluted just like your own equity. So if you used to have 10% options available to give your employees, but you're taking on 50% dilution, that goes down to 5%. And most investors will say, it should be like 10 to 15%. And so you need to create those options, and so that is also dilutive. But that's what you need to do to hire people, and this is something that Danny and Robin know John Lee. John Lee is a former colleague. You like to use these jiffies. But so you need your team. And if you don't have your team, you're going to get nothing, as George Costanza says. And so get used to that. Get used to dilution. Build your company's equity the right way when you start. And just go for building a large company so that ultimately the equity you own can still be significant in an exit. Because you want a small piece of a big pie. That's most often the way to create a life-changing event. there are small companies being built successfully that create great outcomes for the founders. It's going to be hard to raise venture capital for those. Venture capital wants to invest a lot of money in your companies so that they can become very large. So next we'll go into term sheets. Term sheets are the kind of terms that venture investors put into a round or a fundraise to sort of lay the terms out of our investment. Before we do that, were there any questions on founders equity? Okay. So quick overview of term sheets. So term sheets are like a 1 to 10 page document that if you're out fundraising and you get a couple investors excited, a lead investor is going to give you a term sheet, and it's going to be the summary of really brief terms of the important aspects of the deal. How much money they're raising, what the valuation is, and some other things that have been deemed important by the startup and venture community. And it's not meant to be a 3-week legal document creation process. It's meant, we can flip them around in an hour. And so these things are meant to be quick so that you can actually get these terms in front of the startup in a quick way and get on the same terms of do we agree or not on the dilution effectively and the ownership conditions of your company. And it's meant to be exclusive, but it's not a contract. So these things can change. You can get a term sheet and it can then enter an even more intense diligence process, and the investor could change their mind and walk away. You could walk away also. You don't have to stick by it. You just can't, for a period of time, go talk to other lead investors who may give you a competitive term sheet. So don't think of term sheets as the end of the game, and we're entering into a market where term sheets and discussions around companies are exploding. So it's now a venture-friendly environment. The past 2 years of 2020 to 2022 were startup-friendly, where venture investors were really competitive. It was hard to get into deals. Now, valuations are down. Investors are walking away from deals that they thought looked good after a term sheet. Some of the terms I'll go through on this they're all standard. There's a document which I don't think you need to look at but it's the National Venture Capital Association has created a template term sheet. There's a website for it. I have it there. Feel free to go to it and look at this document. It's really not that important, but it's what governs. It's what you would expect to see. And anytime an investor gives you something different, you have to ask why. So think about it that way. And then when. So when do you get a term sheet? It's not at the start of a conversation. It's not the day before an investment. It's generally in the process of you're doing a roadshow as a startup. You're talking to a number of investors, and you're probably several conversations in. Maybe they've talked to a few of your customers, your co-founders. Maybe they've been doing their own work on the side. Maybe you've talked to some of their advisors, and everything's trending positive where they're fairly confident they want to invest in your company, and so they give you a term sheet of that. But then after that, there's a number of things that can happen. One is nothing, because they're so confident they want to invest. It's just a matter of going through the books and the audits and just sort of say okay, there's no criminals here. We think you're good people. Our lawyers are crafting the documents, to an even more intense diligence process where they do background checks, or they speak to as many customers as you're willing to talk to. They have scientific advisors that come in and talk to your company. It's just deeper dives. And so it's after the term sheet that the real process begins to closing. Closing is when they give you, when you all sign the final documents, and they give you X million dollars. And so that generally takes between 45 and 90 days. So I was going to go through some of the important terms that affect your equity and your ability to build your company that are in these term sheets. So let's start simple. Sizing the round. I don't know if you all can see or read the words in there, but this is a fictitious term sheet where this is a real term sheet where I changed the name. So this is Osage University Partners is giving a term sheet to Laserfire. I'm an optics guy, so the company is called Laserfire Incorporated, and Rocket Ventures is a former investor in the company. which is always good to keep in mind who else is involved. And this is a Series A raise where you've generally said you want to raise $8 million, let's say, but I'm saying you're going to raise $8 million. Like that's what we're offering you. You may have wanted 10, but I want to give you 8. You may have said you want 5, but I don't think that's enough capital. And so usually in the phone calls we've had leading up to it, we've said, hey, we think you should raise 8. You know, it's pretty simple. I want to give you a $8 million round. I'm going to write $4 million of that write a check for $4 million of that $8 million round, and you have to go find the rest of the money. So that can come from a number of places. It's called the syndicate. It's your former investors and other new investors that aren't leading the round. And you know, I may have, I don't know if I put it in here, but sometimes I might say like other investors agreeable to Osage University Partners. I might say other investors with a minimum of $2 million from your insiders. That insider piece is important because they know your company better than I do. And if they're not going to be putting more money in to the company, I want to know why. And so usually I would have talked to them beforehand, but you also might put terms in here about that. And so it's, remember, it's not binding, but it at least kind of puts it all in paper how we're thinking about things. And things to pay attention to. So is the lead investor, Osage University Partners, coming in with a big check? If I see, and I've seen this before, particularly in like some really big rounds, but if I were to be looking at it being involved in this syndicate, and Osage University Partners was coming in with a $1 million check of the $8 million of the round, that's not a very strong commitment from the lead investor. The company still has to gather $7 million, and so it's just a strange signal. You really want a lead investor that's taking a big portion of the round. And also pay attention to whether they've coordinated with your other insiders. So is the investor that's leading the round talking to the other insiders to either make space for them or understand what their commitment is? So these are the simple stuff. Any questions on this? Yeah.
Insiders in this are the previous investors?
Sorry, what was that?
Insiders are the previous
Yeah,
investors?
sorry. Insiders I think of as the previous investors in your company. So they're the inside check writers. Okay. So first order dilution. Like this is what drives the first order calculus of your dilution. It's everything we hit on before of how much are you raising, what's the post-money valuation. I don't want to go through this math again. I'll just go through the example. But this is the majority of your dilution. This is where the majority of your decrease in ownership comes from. It's from the raise divided by the post money. So if you're raising 8 million, and I think I forgot to mention before, the valuation for your company was 16. So your post is 8 plus 16. So your dilution is 8 divided by 24, 33%. And so if you were founder number 1, let's say, and you own 25% of your company, the math you would work through is your new ownership goes from 25% to 25% times 1 minus 33. That's like to the first order. That's not actually how it works out because of some other things that happen. But your ownership goes down from 25% to 16%.
Can you, maybe you're going to talk about this, but my impression from talking to faculty is that the biggest issue always is this: what is the pre-money valuation, and disagreements between our faculty founders and the VC. Can you talk a little bit about that process and how negotiable it is, and how to help people be reasonable on both sides about what is, a lot of it is driven by what that pre-money valuation is.
It is the first order of the calculus. Like it is what drives the dilution. It's very negotiable. Like this is, I think I forgot to mention this. Like the purpose of this document is to start a negotiate, or to finish a negotiation that hopefully you've started over conversations leading into it. So ways to make it more valuable, to increase the valuation of your company. Most in the world we're in, like it's generally team. So how strong is your team? At the earliest days, how strong is your team and how big the opportunity that you're going after is. Those are all things that probably have been figured out leading into the term sheet. But after you get a term sheet, what other mechanisms, like what other levers do you have? One is you create competitiveness. So before you sign it, right, you're also trying to get other term sheets. This term sheet, which I changed the name on, was one that we gave to a company that was rejected because they came in with an offer for, I think the valuation was $21 million instead of 16, and so that investor won the deal. So create that competitiveness, and as long as you haven't signed the no shop clause that's a part of these, where you're not going out talking to other investors, you can increase the valuation of your company. But the other problem is, like, you know, you don't want to have this, like there's this weird amorphous period when you're spinning out a company from a university where you don't have revenue, you don't really have your full team in place, and so the valuation math is not a science, and it's almost like a shot at the dartboard, and you don't want it to be infinity, because as soon as you start becoming a real company, you can be measured up against certain parameters. Did you meet the milestones you said you were going to meet if you're a life science company developing a drug? Did you hit $1 million in revenue if you were a software company? And once you do that, venture is really good at assessing the value of your company. And if that value is lower than what you set in what you negotiated in the term sheet, then you have what's called a down round, where your valuation is decreased, and that just sucks. Like, it's not a good situation to be in. And so you don't want to negotiate your value as high as possible. You want to work with the best investors for the fairest deal you can. And so some of the best entrepreneurs will take a lower valuation from VCs that have more experience, or they get along with better. They feel like it's a true partnership. They have better connections to potential customers. So there is this happy medium of it. But you know, there's no science, Robin. But if you take the highest valuation from some unknown group of investors, when you had a great set of investors offering you a lower valuation, that's a very common path to failure. It just shows you're optimizing for the wrong thing. So, but there are second order effects on your ownership, and it's worth talking about some of these because it's something you want to pay attention to even at the earliest days. Because when you sign a term sheet and you take in that investment, it sets the precedent for future investment. So the terms that you accept today will likely be the terms that you accept from the next investor if they're preferential to the investor. So no one wants a worse deal than the previous investor. So always happening is refreshing the option pool, and that can be a significant contributor to dilution. So if you start at the extreme, let's say with you haven't created your option pool, or your option pool has already been completely distributed to all your new employees, you have to rebuild it up to something like 15 to 20% is what we like to see after every new round. Pay attention to where those options are going in. If it's in the pre, that means that you, as the previous owners of the company and investors, will take on that dilution. And so it effectively decreases your pre-money valuation. Like, it's not like we're doing the math, make sure you do the math too. I'm not going to go through it here, although I have it written down. It can be significant. Versus in the post-money valuation, which means after my new money investment comes in, then we create the option pool, and the pain gets shared amongst all the new investors and all the old investors. And the difference can be significant. I'll just quickly show here. So this is additional dilution from a 6% increase to the option pool. If the option pool was in the pre and you own 25% of the company, the impact is 23.5%. And if, with the Series A dilution, that goes down to 15.5% after that. And so this is not meant to be a comparison. I don't think I did it meant to be as a comparison. But it's not what we saw before, right? So you started out with 25% going to 16.7%. And then when you increase the option pool by 6%, your ownership when you started with 25% is 15.6. So you lost another percent as an individual owning 25% of the company just because of the option pool creation. And if it was in the post-money valuation, it just would have been a little less painful to you.
You mentioned that the first two term sheets sets the precedent for the others. Is
Yeah.
it because the term sheets become public, or investors talking to each other about what they presented? Nothing's ever public in a private company, but
if I'm investing, I'll look at all the legal documents from the previous round, and I'll want to match those terms. This is not precedent, other than it's always going to happen with your startup. The amount of the option pool is actually nothing to worry about from round to round. It's just going to happen every round, depending on the stage of your company. The next step I get into is the precedent to worry about. And it's because of the preference stack. So this preference stack is important. So think of the preference stack of, I think we'll have time to go through this, how much money over time you've raised as a startup. So you raised a $5 million round and a $10 million round. Your preference stack is $15 million. And something to keep in mind is venture capital money almost always goes in and is the first money to come out. And so if you've raised $15 million and you get acquired for $500 million, great. Like, that's a great story. People will get their exit based on the percentage of ownership they have of the company. If you raise $15 million and you get acquired for $15 million, venture gets 15, you get 0. So that's the preference stack. It's something to pay attention to. Liquidation preferences govern in that transaction the order by which investors get their money out. And so there's a couple ways that they do it. There's something called preference stacking, which is the last investor sits on top, they get their money first, then the next investor, then the next investor. There's pari passu, which is all the investors kind of share together, no matter when they invested. And there's other flavors of it that you should read Venture Deals by Brad Feld and figure out. Brad Feld's just a great historic investor. He created Mozilla and Netscape. So there's the participating preferred, which is n times participating preferred, which means instead of the investors getting 15 million back, they'll get some, let's say 2x participating preferred, they get 30 million back, and then they get to share in the rest of what's coming out. That's historically, like N in the past couple of years has always been 1, and it's generally been non-participating preferred. So 3x participating preferred is a very venture-friendly term. It's not a startup and founder-friendly term. It hasn't been part of the story for the past several years because we've been in a startup-friendly environment. As people start to play with valuation and say, oh, I want higher valuation, and the investors say, no, I want you to have a lower valuation, you'll start to see terms like this come back, which is how venture investors guarantee their returns. And so those are bad precedents to create in your round. So to the extent you can, don't take participating preferred. Just don't take 5x participating preferred. Don't take 2x participating preferred. Play with your valuation, or at least make sure you walk through the math of when you do take, greater than n equals 1, you know how it's all stacking up. Because, like I said, many of you are going to have startups that raise $100 million, $200 million. And just think, if you have a 2x participating preferred on that, that means the investors are going to be taking $200 to $300 million out first before they take any of your money. So, 1x non-participating preferred is kind of like cookie cutter, vanilla, how most investors like to put their money in. So, any questions on that?
The non-participating preferred just simply means that it's not pro rata after they get their money out?
Oh, yeah. So 1x non-participating preferred means I can, as an investor in an M&A, like a merger and acquisition event, I can get 1x my money back, or I can convert to my ownership. Let's say I own 10%, then I can get 10% of $1 billion. But so does that make sense? So the most favorable to founders is when n equals 1 and it's non-participating. Those are just the good rules of thumb. And there's other things that are important in these term sheets. Voting rights. When these are in the term sheets, it's basically like, hey, 60% of the vote is needed to do, and to take on any next fundraising round, or make a purchase of greater than $500,000. Like, what you want to make sure of is that no one investor, what you want to try and make sure of is no one investor can control that vote. And so, you should be looking at the cap table, trying to make sure your previous investor and your new investor have to work together to get something done. Board directors, it's always good to have a strong board. Also think about an independent chairman. So investors will normally say when they lead around, we want to put someone on the board from our fund, and this is the composition we suggest. Closing date, and also like that's basically when they think they'll be able to get through their process, which you should pay attention to if you're running out of money before the closing date. And then expenses, you as a startup actually pay for the expenses of this legal process that comes after this. So it could be $50,000, $75,000, and it's coming out of the pocket of capital they're giving you. So it kind of makes sense. There's other venture reasons why. And then this no shop clause I talked about, which is, don't go talk to other investors who you want to provide a better valuation. Once you sign this document, you're really, like from an ethical perspective, not supposed to go talk to other investors about leading the round. You can talk to other investors about kind of coming in and joining this firm. So this is a term sheet. It's not rocket science, so hopefully it was helpful to go through it. Any questions on that? All right, so I just wanted to go through, I think I can do this in a couple minutes. An example of how founders' equity gets diluted over time. I told you kind of like general construct of what's fair in distributing equity. I told you about some of the terms by which venture investors will give you capital, and I think it's helpful to go through a situation of raising capital. So Startup Z is raising a seed round, and it's a $5 million round on a $10 million pre, and the post money is $15 million because 5 plus 10 is 15. And so the dilution to anyone beforehand is going to be 33%. The founding structure is 20% option pool, great. Co-founders are going to be 40%, and the lead founder CEO is 40%. And when you take in this $5 million, the new owner, the new venture investor, is buying 33% of your company. So that's this 33% slug here. That's what they bought in Startup Z. And they raised another Series A. Note that the seed round was brought in as a non-participating preferred 1X round. The Series A raises a little more capital, and $15 million on 45. And the investor ownership is now half of your company, totally reasonable. And then Startup Z gets acquired for $250 million. Now, that's great. You've only raised $15 or $20 million. That's a really pretty good outcome. And everyone's happy. They get their percentage ownership pretty cookie cutter with respect to or they get their payout with respect to the percentage of ownership they had. Everyone in that case would want to convert to common from the investment perspective, and that's fantastic. Now, if you were looking at this and saying, I'm a founder, I only made $50 million, which everyone's happy about. Like, what could you have done to grow that? You could have worked harder in in between your seed and Series A to raise your valuation in that company. You could have taken less capital over time. That would have decreased your dilution as well. But the biggest thing I think about is, your goal as a startup founder and executive is to take the $5 million seed round and, you turned it into $30 million of value between the $15 million post money of the seed and the $45 million of pre-money valuation for the Series A. That's pretty great. So sometimes companies don't show much progress, or in the world we're in now, markets are flattening, and you do what's called a flat round. That would have been very bad. Your ownership would have been worse. But so this company did a pretty good job of creating value inflection in between the seed and Series A. Now, the other scenario is the downside of it's only a $25 million acquisition. And so on $20 million of venture capital raised, as I mentioned, the investors take their money out first. And so you can see in this payout on the right, despite only owning 50% of the company, they received well more than 50% of the payout. And a lot of startups would have started the company and said, it would be great to build a $25 million company. Seems like it's life-changing, but it's not, because the founders have only made $2 million between themselves. And don't kid yourself, venture investors are not happy about this. They don't like this. This is like a key thing to realize. $20 million is not the outcome venture investors want when they put in $20 million. Because once we put that money out in the wild and we get it back, we have to give it back to our investors. We can't repurpose it to a different company. And so we're here to make 5, 10x return on our deals. And so we need that, otherwise it's a disappointment to everyone. So in this case, it's just a little bit messier because no one's happy. Any questions on this? So, key takeaways. You need to take on dilution to build your company. You need to pay the bills. You need to pay salaries. You need to buy equipment. And you only do that by taking on venture capital in the world that you all are in. If you're in a startup that's building a car cleaning business, you can go get debt from the bank because they kind of have predictable revenue streams. You don't have predictable revenue streams. Venture capital is generally your only way to build your company. And so make sure you pay attention to the terms that you're receiving as a startup, and do the math. Do the math yourselves to make sure you understand how this will affect your business. Look at similar companies that have trod the same path as you in your sector to understand how much capital you'll need to raise. Like, I talk to semiconductor companies that for some reason, thought I had that off. Semiconductor companies that for some reason they think they'll be able to build their first chips with only $5 million. They all take $60 to $75 million, no matter what. Like, it just takes time. It takes money and time. And so don't think that you are going to be the anomaly in how much you need to raise. You can be the anomaly in how much you raise and how effectively you turn that into value inflection, and that's who we look to invest behind. Don't forget, investors get paid out first, and we're doing the math on the terms that we're giving you. So when we put money or put options in the pre-money valuation, and you say, oh, I want you to share the pain, I might put them in the post-money valuation, but I'm going to give you a lower pre. Like, these are all just knobs we might turn. And so just make sure you're looking at your ownership, because ultimately that's what matters, not the valuation. So that's all I had to go through today. I'll stop there and ask questions. Robin?
Can you talk, I think you mentioned it early on, can you talk a little bit about the impact of friends, family, angel, all this kind of money that comes in potentially before you do a venture round? Is that impacting the valuation? Is that impacting how that impacts when you see that with a company that you're looking at?
Yeah, I mean, as I mentioned before, in general, there's a couple things angel and friends and family rounds can do that are great. They help you bootstrap the company, they help you hire, help you kind of continue, like early conversations with customers, and just get you started when no one else will invest in you. And that's like a reliable and people should use that resource. The hard part is when friends and family or angels create a false sense of success in you, where you think, okay, I've raised $2 or $3 million from friends and family and angels, and they told me my company's worth $30 million. And so, well, that means my next round, just because I've made progress, well, I should be worth $60 million. And that's not how the world works. Like, one, the market decides what your valuation is, but also, unless you had some really experienced angel investors and friends and family pricing the company, like, I don't have any way of, that just means nothing to me. And so that's the challenge of it. And the other thing I mentioned on friends and family and angels is sometimes they just aren't fully aware of the exit horizons of the types of startups that we invest in, that you all may be thinking about. These aren't, companies where you're going to see multiple exit opportunities and you can sell it on the secondary market. These companies take a long time to build and ultimately, sell. I don't know. Do you have anything else that you were?
Well, just how it impacts. Although we hear all the time, oh, we don't want to get any dilution, and we can have a whole nother discussion. But
Yeah. The other thing that happens sometimes with angels is you just have these stacking, like they do the right thing where they set it up as a convertible note, which is when you don't price the round, and you just have these consistent stacking of angel rounds where it's, someone is coming in with $2 million, another person's coming in with $3 million, and you just have this perpetual stacking of convertible notes that creates a mess for the next round of institutional investors. Most importantly, like, who knows what value venture investors really bring to your company, but there are plenty of really good investors out there that I've seen operate, and they can really be helpful in your company. So, you know, angels and friends and family aren't bringing your company advice and guidance, and they might not be bringing you connections that help you build your commercial opportunity. And so if you continue to be able to raise from angels, but you're not getting any value out of them, you don't have a sounding board, you don't have anyone that you can rely on for brainstorming that's seen these patterns over the years, then you're missing out on just a source of advice. So that's maybe the biggest thing I think about. It's like, if there are great angels out there, but if you don't have them, you're really just looking at them as a source of money, which isn't all you need as a startup. Any other questions? Yeah.
So after the Series A round, when you start moving further and further into it, what sort of, when you're hiring on those lead scientists, lead engineers, those key personnel that are sub C-suite, what sort of dilution do you need from an option pool? So like, how much lower each round should you be giving less?
Definitely goes down,
Right.
right? So the more employees you have, I don't have any math for you on it. You know, early engineering hires, it's generally like 0.1%, like when you're like first engineering hire, could be like 1% of your company maybe, but early it's like 0.1%. You know, then for like small, like very just technical like, you know, people that are running instruments, like 0.01% sometimes. There's no rules, but there are resources out there that I just don't, like, I know there's resources out there that people have to help you allocate at different stages of the company. Yeah.
Kind of a follow-up to that, at what point do you stop expanding your option pool?
As a startup,
Yeah.
never. I think you're always growing. You're always needing to refill it. Sometimes it expands less. So at the early days of your company, when you still need to fill out the C-suite, start with 20%. When you have your full C-suite, because you're going to be taking out like 2% chunks of it to hire these really impressive people, as you have them all filled out, all those positions filled out later on in your company, you might only need to create refresh it up to 5%. Yeah.
Another question. So with those milestones and investment strategies for making sure that people stay around, how many rounds do you typically go before you see like full investment? Or obviously it depends on a per company basis and a per person basis, but do you have any insight into like how many rounds you should see before you see like full investment of different people?
Yeah, usually I have rules of thumb, but then there's what usually happens legally. Legally, there's a 4-year vesting schedule where it's a cliff after 1 year, where you get nothing if you leave the company after 1 year. Sorry, before 1 year. And then every year thereafter, you vest a quarter of it. That's standard. It'll always be time-based. But generally that ends up being 2 or 3 rounds. So.
Is it sometimes milestone based?
For advisors and other things, there are milestone vesting. Sorry, but for co-founders, it's generally going to be full-time co-founders and employees. You'd have it be time-based. Awesome. Well, it was really fun to be back here talking to everyone. Email me anytime. I think that's the wrong names. That's not me, but you can email Matt. Feel free to email me anytime. My name's on the website. Yep.
You feel comfortable potentially sharing this slide?
Oh, absolutely. I'll give it out to the OTC team and
It'll
they'll
be
figure
up
out
on
the
our
right way to
site, the video, a little write-up, and the slides, hopefully. So, yeah.
Yeah, and like we are happy to, as a team, I'm a representative of the tech side. My colleague Nia is here. He's an investor on the tech side as well. Email us whenever you have questions. If you're a life science researcher thinking about your next startup, email me and I'll get it to my colleague Matt. Talk to OTC. They're great at helping build startups at the university, and they'll connect you to me or many other investors with any other questions you have.
Why do you call Osage University Partner?
The Osage part or the university part? The Osage part's a long story that's about to get a little bit annoying. There's some bad anyway, long story. Robin, you'll love that story. Do you know it? The university part. So we only invest in university spinouts. And so that created our name. I didn't want this to be a plug for OUP, but I'm always happy to tell our story when we have a call.
Thank you.
All right, thank you.